Welcome back. You're watching IndianOpen right here on BloombergQuint Live, and it doesn't look like today is going to be any different than what we've been seeing in terms of a market standpoint from the last 5 trading sessions. US markets have been decimated. You've seen a 10% drop in a matter of 6 trading sessions, and across Asia, there is that pain that you're seeing. It's lingering day by day. In today's session as well, China is down almost 3%. It's across the board, so you can't really pinpoint one market and say that this has managed to be resilient to this sell-off. The SGX Nifty, a bigger cut that we've seen in today's session, 1.8% lower. That's breaching 11,400 on the downside. The Indian market open is going to be equally brutal, so brace yourselves for the open today. Mayuresh Joshi is joining us right now to talk us through, how can one tread this very precarious path.
Yeah.
It's difficult. It's very difficult, and you don't know where this will stop. Because while we're talking about the new cases in mainland China coming under control, the sudden red alerts are going on across the world. So, the hub is starting to stabilize, but the rest of the world is becoming a bigger concern.
Morning, Devina. Morning, Neeraj. And that's the scary part, right? I think the spread is unknown, and to what extent that spread will be, again, that's a large unknown. And equity markets, risk asset do not like unknowns, right? So this creates the kind of panic that we've probably seen in the sell-off for global equities at this point of time. How long will it linger off? I think you need positive data points coming out over the next few weeks. Because I think the markets have gestated to the fact that GDP is going to come off for this quarter. Economic growth is going to deaccelerate for the global, from a global perspective as well. So global GDP numbers are going to come off. But the rub-off effect, if this continues on global trade and so on and so forth, I think that can have far precarious implications. So yeah, I think that entire overhang is probably what the markets are reflecting. I was just checking out, there were a lot of articles in terms of comparisons between SARS and the current virus. 2003, right? China accounted for 5% of global trade. China is accounting for 40% of global trade at this point of time. So again, I think the proportions in which China's contribution to the world economies at this point of time, I think is largely interlinked. So yeah, I think the markets are probably sensing that if this lingers on further, I think that there will be a huge overhang for asset classes which were anyway inflated because of global liquidity. So yeah, it's a little bit scary at this point of time.
So should you press the pause button on investments right now?
I think the most sensible part is to wait and watch. I think there's no need to rush or hurry.
Let me ask you a counter to that. One is that even if you pause, because that's the easy answer. The other answer is if you're factoring in downsides, would you take some chips off the table and sit on cash?
So ideally, yes. I think if you're making a reasonable amount of money, and that's what we've been discussing, right? I think some of the high-valued stocks, if you're making a reasonable amount of returns, 20-25%, I think you should be taking some money off the table.
You would take chips off the table from your portfolio right now and sit on cash?
I would partially book some profits, at least at this point of time. You will get entry points at some point of time over the next few weeks. At that point, I think the arguments might be in favor that valuations have become cheaper, they were overvalued at this point of time. But largely, again, yes, I think if you are making reasonable amount of money, I think taking partial profits, I think, is a sensible decision. I think take some money off, keep it, I think keep that ammunition dry. If the markets do correct further from these levels, I think you've got cash on your hands to probably enter at the right time.
Yeah, I wonder how would people react to what will we see eventually. Right now, it's the risk-off sentiment which is there, and therefore people are pulling out the money. Once we see the economic impact of this coming in, because hitherto I think the inventories would have kept businesses alive and kicking. If this continues and the economic impact comes in, what happens then? Because even if the scare of the virus moves away come summer, what about the economic data that starts to unravel and not look all that positive?
Though I must say that, post all of the other previous epidemics, the recovery has been pretty swift.
Yes.
Once you've seen it be getting under control. So, I mean, do you feel, but probably the economic situation at that point was very different. Here we are grappling with just getting on our feet to get the economy chugging along, and then here comes coronavirus to become a hurdle in the path.
And do you, sorry, it's a very long thing, but do you prepare yourself for that? I mean, do you prepare yourself for the worst?
It's impossible, right, to predict all these things. So I think anybody putting out a chart 2 weeks back saying that such things might happen on a global scale, I think it's impossible to predict all these factors at play. But largely, again, I think the point that we are driving here is at some point this will get over, right? The point is, at what point is the large question, and that probably creates a huge lingering overhang for the markets. The second element in terms of stocks coming off and whether you should be buying at every major fall that you probably see. My own take is that in such a scenario where you're not sure and where the uncertainty still lingers on, and where the flight of capital is clearly towards safe haven asset, bonds, gold at this point of time, which is an obvious reaction, I think holding on in terms of buying big time, right? I mean, small purchases might be fine, but in what sectors do you probably invest in? Because as you're rightly pointing out, Neeraj, I think the economic implications, once all this is over from a health perspective, is done and dusted over the next few weeks, hopefully. Will start coming off. So again, I think the implications and the profit warnings that a lot of global MNCs have given, I think the annual...
You think it can be that quick? I mean, even for, SARS, I think the minimum time frame that you had was about 10 months to more than a year. And this is becoming, the scale of this is just increasing day by day. So, and it started sometime in the last week of November, the first week of December. Right. So we're just 2 months into this thing.
So SARS lasted 146 days, approximately, and S&P corrected or cracked 12.5%.
S&P's cracked 10% already.
Exactly. So you can actually see the magnitude because of the run-up that we'd seen in the markets before this epidemic came out. So yeah, I mean, keeping your shopping bags ready absolutely makes sense. So you need to create your watch list on sector stocks that can do well, and when to enter and what periodicity of time. I think you will get entry points over the next few weeks. So I think you have to adjust and make those entry points spread out over the next few weeks. But yeah, making the shopping list ready, I think, is appropriate, because as Devina rightly pointed out, post-SARS, the recovery was equally sharp. Aviation, for example, I think they cracked during the SARS outbreak. And it started off in 2002, surprisingly. It started coming out into the markets in 2003. Yeah. It cracked and it recovered in a V-shaped fashion. Hotels, leisure industries. So fashion similar. I mean, you can't draw parallels at this point of time. So I'm not saying that these sectors will crack. You buy into them and then you probably have a V-shaped recovery. But look for robust sectors where I think the earnings momentum will get least affected, at least from a domestic point of view.
Yeah, it'll be interesting to see. I mean, I think we'll get bad news from a clutch of sectors. The only good, one small piece of good news that I saw as I was preparing for the podcast was that the Starbucks global CEO said that around 85% of the coffee stores that were shut in China have been reopened. So they've taken a brave step. Doesn't mean pretty much nothing right now in the context, but at least there's some positive news out there that maybe some businesses are trying to get back to normalcy as well.
I was reading a few articles as well. Apparently, I don't know how true that is, but a few breakthroughs have probably been on the brink in the Israeli
there have been recoveries
medical
also. Quite a lot of recoveries which people don't talk about.
Exactly.
People just talk about modalities and new cases.
And you put out the WHO report, right? What they've clearly mentioned is out of all the cases that have got reported, 80% of the cases are with very mild symptoms, which probably get cured. It's only those 2% fatality cases, and also people having
previous conditions
as well. And summer is going to start, so I think there is some hope that...
it's just the money flow and how that behaves in the near term. That will probably determine what the markets do as well. But interesting to see what India might throw up as well. As we've stated at the start of this piece, that the SGX Nifty already indicates a start which is about 200 points in the red as we speak, and that might only get worsened further. Let's wait and watch. It's also important to track what Dow futures do during the course of the day. Remember, yesterday was the first day when around this time the Dow futures are anyways in the red. For now, they're in the green. But remember, the last few days they've been in the green, and eventually they don't mean anything. So let's wait and watch what happens. But let's take it across to our research team to talk about some stocks in news as well. They will be important. From a domestic trade perspective, there is IndusInd Bank, of course, and there are some others. So Nikki and Shefali join in to talk about that. Good morning to both of you. Shefali, let's start off with you first.
That certainly be a very positive movement, because it was a key overhang on the stocks. A couple of brokerages have also sounded a very positive commentary on the same. So Citi saying that the CEO-related uncertainty ends and the focus on retail is likely to increase from here on, especially on retail liabilities, considering the rich experience the new CEO has with the same. And the near-term asset quality stress, however, may increase as some of the mid-corporates and SMEs and some of the loans under SMA2 category may slip into NPA category. So as of now, they're maintaining a buy rating, and the target is 1,900 rupees a piece. Macquarie has also put out a note, and they're saying that the CEO clarity emerges and the major overhang is now behind us, and that in this move actually ensures continuity and stability, and the fears of kitchen sinking exercise coming in are unwarranted. So they view this appointment very favorably, and they think that the new CEO will focus on the liability side again, especially the fact that there is huge concentration of top 20 depositors. So he may work on that. So the valuations at this point in time are cheap, and it is time to buy the stock. So they have a buy rating on the counter, target 1558.
Okay, well, that's one key stock in news. Nikki, you featured in your list as well, but IndusInd Bank is one. What about the others?
Okay, I'm going to start off with Hpcl and Ongc. These two companies would be acquiring a further 17.3% stake in Petronet MHB for a consideration of around 185 crore. With this, the two companies will hold roughly around 50% stake in the counter, and the transaction is expected to be completed by the Q4 FY20. This acquisition is expected to open up a lot of synergy as well as cost economics and revenue maximization. So overall, it's a positive for both of these companies. We're also looking at GTPL Hathway, where the promoter, Geo Content Distribution, they're going to be offloading around 3.8% equity through an OFS. The floor price has been set around at 63 per share, which is indicative of 4% to 5% discount as compared to the closing market price that we saw yesterday. We're also looking at Syntech Industries, relatively a small counter, but then I expect some negative reaction on that one, because the company is not going to be considering stake sale in its overseas subsidiary due to non-receipt of a favorable deal. Now remember, the company was going to divest in around 25% stake in this company in order to fetch the long-term working capital requirement. With this, the balance sheet is expected to be likely stressed, and expect some negative reaction on this. We'll expect also be looking at last on the list is Motherson Sumi, where S&P has gone ahead and revised the outlook on the subsidiary of the company, and that is Samvardhana Motherson. That outlook has been revised to negative, so some amount of negative news coming in for Motherson Sumi as well.
Yep, thanks a lot for that, Nikki, as well as Shefali. Mayuresh, well, we're scratching for positives. Is IndusInd Bank a positive enough development? You may want to ignore it in a day like this, but how do you read into the development any which ways?
I'll still give it a quarter, Neeraj, because what has happened in terms of reported numbers so far and the dependency that they have specifically in terms of vehicle financing, for example, or even the SME, MSME book, I think there might be some amount of stress that might still need recognition to come through. So to that bit, my own take is that just wait out for one more quarter. At least I'll wait out for one more quarter's numbers for IndusInd.
All right. That's IndusInd Bank, 2015. Remember, this was one of the top banking names and then completely lost its sheen. Let's see, post this period, if at all there's some more interest that comes back in. You know, while we're talking about getting a hold of some of the stocks that you've had in your portfolio and then you would like to add on to, what kind of names are we looking at? So we know a few of them that have corrected significantly, good names. So there's no reason why Relaxo would correct the way it did, coming off from 810 to 720. So is that those kind of stocks a place that you want to be in?
So Devina, clearly I think what we follow at William O'Neill, CanSlim is look out for leaders, right? Leaders in their spaces, leaders where earnings have held up, and leaders where I think earnings should hold up. So there are conflicts of surrounding news flows which probably affect industry stocks at certain point of time. Corona is going to impact everything, right, at this point of time, sentimentally. But largely, again, I think sectors which probably should hold up in our opinion, and that is the sectoral trends that are probably getting thrown up, are, say, gas distribution companies. Because largely, I think they do not get affected. The input is gas, which has fallen off significantly, right? LNG prices have cracked. So to that bit, input costs coming off, volume still expected to hold up because the consumption, both from a PNG and a CNG perspective, is still going to continue. So I think gas distribution players can really do well going forward as well.
This whole
city gas.
No, but what I'm trying to say is this whole move from PNGRB to allow competition will that not be a hindrance?
So there is enough, Neeraj, still to be done, right? So the market share for renewable energy, or let's say natural gas at this point of time, is only 6%. The government clearly wants to take it to 15% over the next few years. So for the size that we are looking at, I think there is enough space for a lot of players to probably operate and make comfortable amount of money from a profitability perspective. So the earnings quadrant should hold up for these players. Consumption as a basket, right? And we've been talking about various stories within that. So FMCG as a pack should continue holding on, but selectively again, because I think input costs have risen for a few players as well. But largely, again, I think the dependency in terms of China for raw materials probably does not exist for these guys. They've got alternate sources and they've got the leeway of increasing prices. So consumption as a basket, specifically FMCG, I think that can hold up as well. Footwear that you're talking about, right? Larger part of consumption. But I think the run-up has been quite significant for all these stocks. So I think there's going to be a natural knee-jerk reaction in terms of all this coming off. But the demand drivers probably still continue. And then rural, surprisingly, if you look at the entire basket over the last 9 months, rural, which outpaces urban, has actually underperformed. So to that bit, again, yes, consumption as a pocket, city gas distributions as a pocket, in my opinion, those are the stocks within those sectors which should be probably on your shopping list when you're probably looking at getting in over the next few days.
Okay, what would, between an HDFC Bank and a Bajaj Finance, what would be on your shopping list? If you have no money right now. Yeah, so not that they've really cracked a lot, but still, they're relatively cheaper than what you had thought of entering them.
So we continue holding on to HDFC Bank, right? We're still holding that in our suggested portfolios that we've got. The overhang in terms of the management change still lingers on for HDFC Bank. But largely, I think the parameters that one looks at, asset quality, loan growth, cost to income, I think all that holds up along with tier 1 ratios. No doubt about Bajaj Finance as well, right? The base that they were operating out of and the numbers that they keep on producing quarter after quarter, I think stupendous set. The cross-selling opportunities for the base that they've got, I think is huge as well. And the kind of technological innovations that they're bringing through, I think that probably also entails a lot of cost optimization on the front of an earnings quadrant. So I think if you look at both these companies, great business models, no corporate governance issues at all. So difficult choice to make, but I think we've still held on to an HDFC Bank in our portfolios.
You would add on to an HDFC Bank in this current period wherein you're of the opinion that it's better to take profits also of some stocks. Would you do that? Would you take profits of some, but maybe buy some HDFC Bank as well at the current valuations?
So maybe we'll wait and watch. I think if it corrects, I think maybe it gives an opportunity for us to get into it.
I think the scary part is what's happening to companies which have these global linkages, the likes of Motors and Sumi, for example, wherein we know it's a leader, it does some fantastic work, but the price damage is testimony to the fact that the business is so globally interlinked. And autos anyways are seeing a bit of a downtake, and with China facing the brunt of coronavirus, that demand is anyways going to be under problem. So a Tata Motors, a Motors and Sumi and the likes will anyways be under a bit of cloud, and I think extremely unpredictable to figure out when the turnaround could happen for some of these businesses. So that's that one scary part. They are large businesses in their sectors, even though they are kind of forgotten. Motors and Sumi is arguably the largest auto bank. Tata Motors is one of the largest auto companies, and that's the problem. The other bit is, Devina, the kind of punishment that the market has meted out to a Maruti, right? I mean, in that sense, not globally linked, but yeah.
In comparison to Tata Motors, I mean, Tata Motors, honestly, 17% cut for a bulk of the revenues coming from China, that's not a mean punishment. I mean, that's fine. For a Maruti also, you would have probably anticipated Tata Motors to get beaten down further, because for JLR, anyways, we're struggling. And now with China, the biggest market for them, completely shut out. I mean, 17 is probably a handout, I would say.
Yeah, so Tata Motors was obviously, I think, going to come under the cloud, as Neeraj was rightly pointing out. I think Maruti's case is a little bit more surprising at this point of time. I think it's the general reaction which is pulling all these stocks lower. And you can ascribe any number of reasons that you want at this point of time, because I think the numbers will come and reasons will come by plenty.
Actually.
So I think it's better to wait and watch. Again, I think BS4 to BS6 transition, discounting on inventories, whether demand will come for BS6, price hikes taken on petrol variant.
And general risk off. Well, I think Mayuresh makes that very valid point. Reasons will come. The point is, you got to be mindful of when do you want to put in your hard-earned money to work, and this may or may not necessarily be a good time depending on your time horizon. Well, speaking of timing, Devina, good time to get in some technical opinion as well on a day like this, on a morning like this. Shrikant Chouhan, Senior Vice President of Technical Research at Kotak Securities, joins us on the show. As the Shubham Agarwal, the CEO of Quantsapp. Shrikant, let's start off with you first. What do the charts indicate? I mean, would you take any trade on open? That's a simple question.
Certainly, yes.
Certainly, yes.
Yeah.
Okay.
The reason is because the market is opening down with a gap of 200 points. Okay, and we were like expecting that if market breaks 11,600, then the next level to watch out for is between 11,430 or 350 area. It's a corrective pattern because the market has shown spectacular rally from the levels of 10,600 to almost 12,450 without any meaningful correction. Okay, we saw those levels, and now it's a corrective pattern to the same, and we saw these levels in a very short span of time, and or maybe we are seeing these levels in a very short span of time. So certainly it's a corrective pattern, and it's an end of corrective pattern. See, whatever, like whenever we take a call on the market, we use extensions, retracements, and based on that only we take the call. So event comes, event goes, right? And like it comes in different forms. So we cannot like say that because of this I cannot see my charts, or I will not take any specific call and all. So we have to take the call, and if our parameters are like matching, so certainly yes. So if we are really going to see these levels, maybe 380, 370, then certainly it's a buy. Buy good companies, take out of money, buy out of money call options of the current series. I think certainly they are going to reward you because huge bounce back is not ruled out.
Okay. Well, Shubham, coming on this, how are you approaching trade today? Because when I was looking at the open interest distribution on the option, it seemed like some of these will run for covering those positions, and that might only, add to the pain. What is your approach to trade today?
Hi, good morning, Neeraj. In fact, if you look at the derivative data for a very long time, derivative data has been indicating that major shorts were created post-budget, and even though a rally happened towards 12,000, but those shorts were never covered up, and that was kind of a pre-indication that we might see a correction. Obviously, this 200-point gap down was not something which was expected, but looking at the prior data, I think we would continue to believe that this breakdown that has happened might get extended towards the level of 11,000. And I wouldn't want to go ahead and catch a falling knife because generally we see that whenever a tail event happens, the maximum risk actually remains in the tail event. So 11,000 roughly is what I'm expecting. And I think the way most of the sectors are placed, you have major shorts in auto and most of the other sectors other than the consumption theory. So I think it will take some time for all of these to stabilize. So for now, from a trading perspective, I think any pullback that happens after the gap down opening, I think will get eventually sold into, because the market is still heavy in terms of positions, which needs a crowding out.
Okay, so well, opposite opinions, and it's always good because people see data and charts very, very differently. So in light of that, Shubham, maybe I'll come to you first and then go to Shrikant. What are you doing in terms of specific trades, either on the index or on specific stocks?
Neeraj, certainly we have a couple of calls, but I don't know how relevant that will be after the gap down opening. But still, both of the stock structure will still remain same. So for now, Hero MotoCorp, if we look at the long-term charts there, we have a breakdown on the medium-term scale. But more importantly, if you look at the open interest data, because the stock was quoting at the support area for a very long time, a huge accumulation happened in the open interest, which is indicating that the stock is kind of over-owned. And because of this over-ownership, there's a good possibility that, after this breakdown that has just happened in Hero MotoCorp, there might be a unwinding of all those positions which were getting carried forward. So I think Hero MotoCorp overall, there's a decent downside that we're looking at.
Okay. Well, we'll watch out for these names, or at least Hero. We'll get another call from Shubham. But Shrikant, your ideas as well, because you are, I'm guessing you're playing for a bounce. On the stocks as well, are you doing that?
Certainly, yes. We like State Bank of India. It was around 322, 323 yesterday. If we see the market or the stock is opening somewhere around 310 or 320, 315, then certainly it's a buy, because again we are expecting rebound. The stock is forming some consolidation formation. So at least till the event of this credit cards IPO, we are expecting rebound or buying on every decline. So certainly it's a buy on declines around 310 levels with a stop loss at 300. Again, we can see the levels of 330 or 335 on the high side. We also like to add a few companies or few stocks from NBFCs like Bajaj Finance, which was trading higher, and when the market was moving higher, the stock has made a new high. So it's an excellent buy if it falls to important support areas like it was around some 4750, 4760 yesterday. If we see the stock is falling to 4550 or 4600 levels during the day, then certainly it's a buy with at least short-term view.
Okay. I think we've got Shubham back with us. Shubham, I'm sorry your line got cut off a bit. Could you just complete your stock ideas?
Yes, so Hero MotoCorp and BEL are the two stock ideas which are structurally short. So the 2050 strike put option can be bought on Hero MotoCorp. For now, we are looking at a target of 60 and a stop loss can be maintained at 38. And the second call is on BEL, which saw a breakdown a couple of days back, and the breakdown might see some more extension. So a 75 strike put option can be bought, 5 rupees will be the target, and the stop loss can be maintained at 1.5.
Okay, I think we're just about under a minute left to go for market pre-open. It's not going to be a good one. The SGX Nifty is now down 2%. That's 240 points under, so 11,369. And if you add up today's losses and the way on the back of the SGX Nifty, you would have retraced half of the rally that you saw in the month of September post the announcement of the corporate tax cuts. So that was the time where the index moved from levels of 10,700, propped up in a single day, and then from there the rally took it all the way to make record highs at about 12,400. From there, counting today's move as well, you would have retraced half of that rally already. About a few seconds left to go. Asia as a pocket again is looking weak. Individual stocks are going to be monitored. IndusInd Bank, particularly on the announcement of the new head at the helm. So we'll watch out for that one. The rest of the other heavyweights, HDFC Bank, Reliance Industries, whether they dip further and whether or not then those get attractive entry points. Those become attractive entry points. Nifty 50 opening lower, but the cut is not not compared to the SGX Nifty, but this is just initial takes. So remember, the full impact of it will come towards the end of the pre-open session, and therefore the opening will be more important then. Individual counters then, starting off first with some of the key movers. On the downside, you've got the likes of Adani Ports, Asian Paints, marginal cuts, not too much in terms of heavy cuts. GAIL is the one which is showing you a 9% drop. Bharti Infratel is the one showing a 6.5% drop. Tata Motors, another 9%. Again, so these names will keep changing and the quantum of cuts will keep changing in the first few minutes of pre-open. So don't get too bogged down by that. Infosys is down 4%, SBI is down 3.5%, ONGC is down 3.5%, Vedanta is down 3%. Eicher Motors, Tech Mahindra, HCL Tech at 560. I think it's pretty close to the rates at the time that the bonus got factored in. Coal India 2 at 171. Remember, 6th of March is when the board is meeting to consider a dividend. We're hearing closer to 21 odd rupees. Street talk. Maruti Suzuki 1% under, 6217. L&T at 1200. Asian Paints is down as well. Two stocks in the green, namely Bharti Airtel, which is showing you a 4.5% pop, and JSW Steel. Surprising to see a steel company amongst gainers, 1% higher for JSW Steel. The currency, just looking at that, a big drop in today's session, so 71.9 is where it's at, so very close to taking down 72 if things continue the way they are.
Yeah, well, not much. I mean, broader markets, almost everything would have started off lower, so I don't really need to dwell too much. Just before we get in, a very important global voice. Just want to mark 2 or 3 names. Vodafone Idea should come up on your screen. It's a small name, but should mark what's happening because it's an active monitorable. Watch out. Repcom Finance looks like starting off weak. The whole network eating group looks like starting off weak. JSPL looks like starting off weak. Almost all of those names. Not too much on the gaining side. Bharti Airtel is amongst the top 5 gainers on the Nifty 500. That tells you the extent of damage at the broader end of the spectrum. But as we've said today, important to get in as much opinion as we can. And sticking to that, get in James Sullivan. He's head of Asia ex-Japan equity research at JPMorgan, joins us right now from our studios in Singapore. James, thanks so much for joining us at BloombergQuint. Appreciate you taking the time out. How bad is the situation looking amongst money managers, James? Is the risk of here to stay, or is it difficult to predict?
So I'd make a couple of comments on that question. First, I think it's very important to recognize the starting point, particularly from a market's perspective. If you look at where markets started the week, you had many major global indices at or very close to all-time highs. You had very many bond indices close to all-time lows. The U.S. Treasury 10-year was 5 basis points off an all-time low. You had gold at a 7-year high. You had cyclicals versus defensives at valuation gaps that we haven't seen since the peak of the TMT bubble in the late 1990s. And so the starting point from a market's perspective here is extremely important, because we were looking at very stretched markets. And so the downdraft that we're seeing this week needs to be put in the context of that overall statement. From an economics perspective, I think what we're going to see from here is very clear. We absolutely must see both earnings as well as GDP cuts over the course of the next couple of weeks, and that will likely drag on markets. The interesting thing here, however, from my perspective, is while those cuts occur, we're finally starting to see some of the high-frequency activity metrics out of China start to stabilize. And so if you look at traffic statistics across many major Chinese cities, if you look at shipping statistics and a lot of the custom indices that we run at JPMorgan to try to understand live manufacturing activity on the ground in China, those are actually starting to stabilize. And so earnings will generally lag reality. I think we'll see that in this instance again. The fact that markets entered this conversation at extremely elevated levels is an important part of the conversation. And so as we look forward into the second half, all of that has to be taken into account.
So in light of that, James, since we're considering the fact that while cases in mainland China would have started to drop, the rest of the world is starting to peak now in terms of new cases of coronavirus. Any which ways, the hub of the supply chain, which has been China, most likely will extend beyond this quarter. In light of that, is the market pricing that in, or there's still more downside left to go because we've still not seen the full-blown proportion of this?
So my personal expectation is that you will see markets weak, at least over the course of the next couple of weeks. Again, we will see an acceleration in virus activity in multiple countries around the world as we enter that accelerating phase of the overall development curve that we've seen in markets like China, that we've seen here in Singapore, that we're starting to see in markets like Korea. And that will be a negative drag on overall economic activity. We are also still, as we said, primed to see a lot of earnings and GDP cuts over the course of the next couple of weeks. And so I don't think that the market sell-off is necessarily finished. For investors that are willing to look through that, however, we still are looking at this as a time-defined event. Yes, it will destroy demand in the first half, but as we look forward into the second half, there's two critical conversations that we're having with clients right now. Number one is, what is the degree of economic pickup that we will see naturally as activity starts to reemerge in markets like China? And again, we're already starting to see some early signs of stabilization on those statistics. Second, and very interesting, is the reaction function that we're seeing from both central banks and governments. We at JPMorgan are now penciling in a 25 basis point rate cut from the US Fed in the July announcement. We did not have that in the forecast previously. If you look at budgets that are being issued in markets like Hong Kong this past Wednesday, it's one of the most stimulative budgets and one of the largest budget deficits that Hong Kong has ever seen. And so governments and central banks are really starting to step up to try to stimulate their way out of the short-term weakness that we're seeing. Now, the fascinating aspect of that, from my perspective, again, is that if this is a time-defined event, a lot of the stimulus won't actually hit until the second half. And so one of the second conversations that we need to start having now is, what if we face an overstimulated global economy in the second half of 2020? What implications does that have for activity? What implications does that have for inflation statistics globally?
So, James, just to carry forward to that, you spoke about Hong Kong, and most of the conversations around, the big handout that the Hong Kong government is giving to its citizens is that this money actually may not be put to use by them. It will not go back into the system unless and until there is some meaningful indication that workers are going back onto their jobs. So the point of that being, it'll just lie idle without being put to good use.
I wouldn't disagree with that statement at all. There's a very, very well-established body of academic research that shows a one-time gain given in a period of uncertainty is far more likely to be saved than spent. And that's a very important statement given that roughly 71 billion out of the 120 billion Hong Kong dollars in stimulus that the current budget implies is based on this 10,000 Hong Kong dollar per person giveaway. If all of that goes into savings accounts, then the budget is not nearly as much of a stimulus as it would appear at first glance. And so I would very much agree with that. And again, there's a very, very large and well-established body of academic research to support that thesis.
Yeah, but I think James' point is well taken, because I think if I look at history around SARS as well, the Hong Kong government's announcement of a 1.5 billion relief package probably helped markets then. James, the other point is, while things around China, as per your indicators, are looking like stabilizing, the breadth and the pace of the outbreak in the other areas, some of which might not have the possibility to quarantine things as effectively as China has, and that pull down in economic indicators. More importantly, that pull back of risk on money and the impact that might have on equities. I mean, maybe the impact of the virus is contained, but what if the risk off mood only sullens further? What does that then do to equity valuations, equity levels?
It's a great point. And if I take a step back, very simplistically speaking, there's only two things that can move an equity market. One is earnings, the other is the multiple that is applied to those earnings. We still see an adjustment function remaining. We still see earnings cuts to come. But the point that you're making is extremely relevant, in that the multiples that we are talking about in most major markets around the world are at very elevated levels. And so we do incrementally see the opportunity for multiple contraction as we go through the next couple of weeks, next couple of months. And so you put those two dynamics together, and it's difficult to argue for a resumption of the bull market over the course of the next couple of months. That said, as we then transition into the second half, the potential to see an overstimulated global economy on the back of central bank rate cuts, on the back of very aggressive government stimulus in fiscal policy in multiple countries around the world, is something that we need to better understand as we go through the year.
James, one last question with regards to foreign investors and the kind of fund flow activity that we've been seeing, particularly for the emerging market pack. Now, while India may not directly have large number of coronavirus cases, there's a trickle-down effect of supply chain disruption that will impact companies out here. And while obviously India-centric direct fund investments don't happen, they happen as an allocation to the emerging markets, and then a part of it goes to India. Do you see that getting hampered a bit?
So India, from a bottoms-up fundamental perspective, is not nearly as exposed in a lot of our other large regional markets, particularly China. If you look at the import-export statistics out of India, India actually imports 4 times the value of goods that they export to China. And so it's actually relatively defensive from that perspective. But you're right, if there is a larger risk-off trade, ultimately emerging markets trade, in our belief, off of their growth premium to developed markets. And so if we're starting to question global growth on a short-term perspective, if we're starting to question in particular emerging market growth, then the asset allocation into emerging market funds would likely suffer on that dynamic. Again, for us, this is still a time-constrained conversation. It's still very much first half versus second half, but from a short-term asset allocation perspective, I wouldn't disagree with you.
James, we leave it at that. Thank you so much for joining us this morning. Really appreciate it. James Sullivan there of JPMorgan. We've got about a few minutes left for market opening, so let's tell you all that you need to know to stay ahead and trade today. Indus Bank names Sumant Katpalia, the next MD and CEO. He takes over from Ramesh Sopti on March 24th.
Hpcl and Ongc will acquire 17.3% stake in Petronet MHB for over 185 crores. Post-acquisition, companies will hold 50% stake.
S&P revises the credit outlook for Motherson Sumi's subsidiary Vandana Motherson Automotive Systems Group to negative.
Pidilite Industries will acquire 70% stake in Tenax India Stone Products for 80 crore rupees.
Macquarie initiates coverage on Container Corporation with an outperform rating and a target of 625 rupees per share. Says it's a rare combination of a market leader and a disruptor.
Well, the going is not looking good. We are likely to start off 685 points lower, 1132 and counting. And a clutch of these banking names too have cracked big time today. You've got to keep that at the back of your mind. Quick thoughts out here before we take in the top calls. Shrikant, Chouhan, what do the charts indicate on Tata Motors?
For Tata Motors, I think the stock is under pressure, no doubt. The stock has broken its important support area at 145. But if we go through with its medium-term chart, then I think close to 130, 135, the stock is having very good support. So there, if we see the stock is sustaining, then only we should look for buying. But at present, if we correlate this with other news flow in the market, then it is better to stay away. And we can focus on maybe Maruti or Hero Motors.
Okay, keep in mind all Nifty 50 stocks are likely to start off in the red if the pre-open rates are to be believed. GAIL is knocking on the doors of 100. Shubham Agarwal, quick thoughts here. Gas Authority of India.
So Neeraj, if you look at the movement in GAIL, it's quoting at a very important support of 105. But I think given the market situation, there's a good probability that we might see a breakdown happening from there. So I would be betting on a breakdown. One can look to go short with a small stop loss at 110. And in this breakdown, we can look for a target of 98.
Mayuresh, quick thoughts. You mentioned about the HDFC Bank, Bajaj Finance, etc. Quick 30 seconds. Is there a stock that you would keep on your radar? You mentioned about keeping the shopping list ready. That one name that you will keep on mind, even if you don't buy it.
So I think HUL, for example, because of the merger news, I think the earnings upgrade will just come through. Least affected, in my opinion. I think they will, but not that much. IGL, again, from the city gas players. But again, it's a watch list, so I think you just need to keep it on your radar. Entry points probably would come over the next few days or weeks.
All right, let's get into stop trading ideas as well. Shrikant, let me come to you first on one stock that you would like to enter into.
See, apart from State Bank, if we really focus on other stocks, then those stocks which have made new highs, like Asian Paint, is certainly looking good. It is currently trading around 1840, 1845 levels. So if we see the stock is opening somewhere close to 1800, then it's a great buy with a stop loss at 1780 on the downside. Again, we can expect 1860, 1870.
Okay. Shubham, your top call.
So Bank of Baroda will be a short. Structurally, there are enough shorts. So I'm looking at a target of 74 and a stop loss can be maintained at 81.
Okay, gentlemen, stay on. We'll probably just take in opening thoughts from you as well, because we are likely to set up for tumultuous start. The question is, can that get further worrying? That's something that we'll know in the first 15 minutes of trade, but you're likely to start off 2 percentage points lower. Here's how we're starting off on this Friday at 2.29%, 265, around 11,360 or 11,353 now for the Nifty 50. Sensex about 1,000 points lower at 2.5% lower, and the Bank Nifty 750 points, 2.5% lower as well. So that seems to be the opening tick, 2.5%. Let's see how we navigate through during the course of the day. The mid cap and the small caps indices should come up on your screen. Well, same degree of ferocity of the fall on the mid caps, 2.5%, and the small caps too, which usually don't start off with such a bang, are down about 1.8%. Doesn't look like the markets are in a mood to have any kind of a pullback, and maybe shouldn't be. The world markets are looking worrying. All 50 stocks in the red. Britannia is the best performing stock, down 0.5%. UPL, Bharti, Nestle are amongst the lesser losing out stocks. But it's surprising that I'm talking about Kotak Mahindra Bank as being the top performers when it is down about 1.5%. Usually, when Kotak does that, it's amongst the laggards. What is lagging though? Tata Motors down another 5%, Tech Mahindra 4.5%, Bajaj Finance 4%. JSW Steel, Vedanta, GAIL, Bharti Infra, that's the list of stocks which is really corrected. I don't see HDFC Bank amongst the top 20 losers, but Reliance is down about 3%. ICICI Bank is down about 2.5%. HDFC Bank, surprisingly, a lot more well behaved than some of its other counterparts. So amongst the heavyweights, Reliance down 3%, HDFC Bank down 2%. That's the point. Mind you, the Nifty Bank slightly better than the benchmark indices. But what about the globally linked companies? I mean, we've spoken about how Tata Motors is the worst performing stock. Let's look at the broader end of the spectrum. Some of these other companies which are also looking wobbly or should be looking wobbly. So Avanti Feeds 8.5% lower, Mindtree IT name 3.5% lower, Mothers and Sumi 5.5% lower, very close to the 100 mark. So almost everything with any kind of global linkages is looking weak. Actually, everything is looking weak. What about companies which have actually weathered the storm better? The last 7 days, these stocks have actually been the best performers, but all of them start off weak today. India Cements, well, a bit of mean reversion, 6.5% lower. Max Financial still holding strong, 586, but down about 1.5%. And Naveen Fluorine, which had a terrific run post that contract, is down about 5% as well. Devina, I don't have any luck. Everything is in the red. The Nifty is now 312 points lower. What are you spotting?
Well, I'm spotting that Dewan Housing Finance is in the green. That stock's up about 0.5%, and Lakshmi Vilas Bank, and that's it. two stocks in Nifty 500, which are in the green, and the rest of the pack is all down and out. PFC seeing a cut of about 11% this morning. We've got Avanti Feeds 8.5% lower. Godfrey Phillips down 8.5%. Trent, a name like Trent is down 7%. Obviously, we're talking about heady valuations here, but that stock's down. India Cements, with all the excitement around the new, investors coming in, the Manis, that stock's down about 6%. Then you've got the likes of Kitex Garment, 6.5% down. First Solutions. Shipping Corporation of India, Naveen Fluorine is down 5%, Prestige Estates, Bharat Electronics, Wellspun Corp, everything. So there's no point even reading out the list because you're probably going to throw a dark in the dart and it's going to hit something which is red. The breadth of the market is extremely weak. Double digit, 86 stocks are the only stocks that are in the entire universe which are trading, stock universe which is trading in the green. 1,167 stocks are trading in the red. So that tells you the breadth of the market and the sentiment in the market this morning. Extremely down and out. 300 points, approaching the cut of 300 points now for the Nifty 50. For the Nifty Bank, we're down about 650 odd points. Shrikant, you still okay to go long?
Just see,
stick to your call if
We're not here to influence your calls. You just
no, not at all.
Just
not
question you.
Yeah, absolutely not at all. See, the market, if we go through with the history of last 20-25 years, then whenever the market stopped at any level and it recovered at the same point where the retracement level comes or where the extension level comes, and we have to give the weightage to the same. And this time also the pattern is very clearly corrective pattern. See, I'm not defending to the view, but it is very clear that, see, after forming the high of 12,430, 450, the market has made a high of 12,250, 260 levels. So if we cut that 200 points from the levels of 11,600, then it comes to 11,400. So it's a clear-cut ABC pattern which is completing in today's date, and time basis on the basis of time also, the market is completing its corrective pattern in next 1 or 2 days of time. So certainly it's a buy. It's a buy for buy with a view of next 2-3 days, but buy out of money call options. Buy those companies which have made new highs like Asian Paints, Bharti, Bajaj Finance. I'm very much sure that traders will make money out of this.
All right, I want to talk about those 3 new entrants in the F&O space that come in today. Info Edge, Bandhan Bank and HDFC Life. If we have those on, no major expectations of any big moves here, but stocks are down. Bandhan Bank's down about 3.5%, HDFC Life to 1.7%. HDFC Life, though, has been trending downwards in the last week plus. And this probably could look like a good entry point, but we'll get in our guest to comment on
Certainly.
that. Before that, I just want to quickly look at what crude oil prices are doing right now, because that's another element that needs to be closely watched out. Focus is just getting more and more deeper in the red. $51 per barrel on Brent crude. Vandana Hari, founder at Vanda Insights, is joining us right now on the phone line from Singapore. Vandana, thanks very much for taking out the time. While heavy crude importers like India would probably view this as a positive sign that the crude oil prices have come off so sharply, but what is it doing in terms of the overall demand picture? And also the fact that IEA is putting out estimates of daily productions which are far lesser than what we had anticipated.
Good morning, Davina. It seems like we have reached a cliff edge with the coronavirus. So the past couple of days, and particularly the overnight developments, where it seems like the contagion has established a foothold in the U.S., that has what has spooked markets the most as of yesterday. We have had people cautioning, flagging the risk of recession starting in the U.S. and a global recession for the past several months. And increasingly now people are thinking this might be the final straw that just pushes the world into a recession. In such a situation, if you ask me what might happen to world oil demand, I would say it's like trying to catch straws in the wind. The situation is still unfolding. It's very hard to guess where this may peak because, until last week we were worrying about a peak and a plateau in China. Now this has become a global problem. So as far as oil is concerned, we already, the new front month May Brent contract is already looking at to crash through $50 a barrel, and I don't see a floor in sight.
Okay, that was going to be my next question. You kind of preempted. Vanda, just one quick thing then. If you don't see a floor in sight, which is one thing, do you foresee sharp, sudden weakness, or now it will be a bit more gradual after the sharp cuts that we've seen already?
I think that will depend largely on what headlines we see coming out on the coronavirus. Now, you may ask, what about OPEC, non-OPEC? And we have had news overnight that the Saudis are pushing for a 1 million barrels per day additional cut instead of the 600,000 barrels per day that was proposed by a team of experts earlier this month. But, I think the situation looks to me like it may have gone out of OPEC, non-OPEC's hands for the time being. So we just have to wait and watch. So if we have worse news on the coronavirus front, especially what happens with the spread in the U.S., it is already spreading like wildfire in Europe and the Middle East. So if we have much worse headlines regarding the contagion, I think the oil market is going to completely ignore what OPEC, non-OPEC are doing or not doing, and we could see further sharp drops. Otherwise, if it's just more of the same kind of news, I would expect a gradual descent from here on for crude.
Okay, Vanda, we'll leave it at that. Thanks much for taking the time out and being with us. Shubham Agarwal is with us as well, and then we'll take in final thoughts from Mayuresh as well. But Shubham, Devina was asking about HDFC Life. Quick thoughts here.
So HDFC Life, I think because no positions on F&O and hardly anyone would had been able to create a short position, and I think that's why it's still holding on. I think this is one of the well-placed stock. Market situation is certainly bad, but I think still one can look for a positional bet on the long side. 535 will be the stop loss, which is a very important support, and I don't see that breaching at least in the near term. And roughly 600 to 610 will be the target for HDFC Life.
Okay, gentlemen, all of you, thank you so much for taking the time out and being with us today. Really appreciate your time for being with us this morning on such an important day. Well, 300 points lower for the Nifty 50 and 2.5 lower for the Sensex as well. Jyotivardhan Jaipuria joins in as well, founder and CEO at Valentis Advisors. Jyoti, painful times, yes. My question is, are you staying put as far as buying goes, or are you selectively even nibbling?
So, we are selectively nibbling because we have been sitting on cash levels. The markets were looking expensive, and so to that extent, from a valuation point of view, this has provided a correction which hopefully will make markets look a little more cheaper and provide better buying opportunities.
Okay. Jyoti, just wondering, is this a factor of bottom-up valuations which are looking attractive on specific names, or do you reckon that the damage due to the coronavirus scare now has in part played out and therefore may not be too severe going ahead? Are you taking that kind of a call, or is it largely bottoms up?
No, so what we are doing is just nibbling a bit. It's not like we're putting all our cash to work. So there are 2-3 issues. One is, I think the impact of coronavirus is unknown, uncertain at this point, because it seems to be, expanding at a pace which people didn't think would happen a few weeks ago. At that time, it was all like this is largely contained into China, and now it just seems to be spreading all over. So to that extent, the impact is not known. How long it can last is not known. I think what we can make out is, at least for the next few months, the global economy and economies across the world will be subdued, because I guess, normal trade is going to come to a halt. People moving across countries is coming to a halt. So that the economy will be subdued. Second is probably now this means that the Fed, which earlier was expected to be on hold, will at some point start easing again in a bit to, keep the economy going. So, that would be a bit of positive for the market. Ultimately, over the next few weeks, it will depend on the severity of, the spread of the coronavirus, how quickly it spreads or whether it can be contained, which will determine where markets really go.
Okay. Jyoti, in light of that, is asset diversification, asset class diversification a prudent step right now? I mean, you have gold, which is hitting new highs, versus equities, where right now the fund money is moving out of. So, I mean, and considering that you were not fully deployed at the peak, you still have some spare cash lying around, that would be better worked around in something like a gold?
Okay, so like I'll look at it in two ways. One is for us, particularly what we have is money which can only be put in equities. So our choice is to keep it in cash or invest it in equities. We can't do other asset classes. But for the investor in general, I would say at any point of time, they should have asset allocation in mind, because all these things, like today when equities are doing badly, it seems like, yeah, gold is a great bet to have. But it's something which you should do across your life, because you don't know at what point equities do badly or some other asset classes do badly. So there should be some asset allocation always which you have, and you should spread your money into different asset classes.
Right, so asset allocation is something that investors can look at. Defensive as a play, Jyoti, some money to defensives just to protect a little bit of capital?
Yeah, so if you look at the last 10 years, it's all been about defenses. Defenses are the one which have done well, and we were sensing that tide is turning, and things are going to move more towards value. So if you see the last 6 months, and even after the current falls, it's like the non-defenses which have done better. Actually, mid caps have outperformed the large caps over 3 months and over 6 months, because we were starting to see defensive had become too expensive, and the valuation at the other end had become very cheap. So we were starting to see that trend moving. With what has happened over the last few weeks, I think that trend will stall. But if you ask me over the next 3-year view, I would still say that defenses are very expensive. That's not the place to be. In a very short term, as a tactical play, probably that is where you want to hide, I guess.
Jyoti, are you even remotely thinking of buying any global cyclicals right now because of valuations?
So we're watching them. If you look at global cyclicals, they are not as cheap as they were 4 months ago also. So what we saw is a very, very sharp rally in a lot of the steel stocks. And they've come off from the peak, but they still not reached the level they were few months ago. We typically tend to buy global cyclicals when they are very cheap, and then we just wait for the cycle to go up. So if you see a lot of the steel stocks in India, they tend to bottom out around a price to book of 0.5 to between 0.5 and 0.6. So that's the sort of levels we always look at. If we get levels coming closer to that, then we buy them, even if things are looking very bad for the cycle in the next few months, because these are cyclicals. You tend to make your money when the cycle turns, but it's very, very tough to predict the cycle. So they have become cheaper. They've not yet come to the levels they were 4 to 6 months ago, but if we get somewhere close to that, then we would definitely be looking to buy them.
I just wonder, Jyoti, at least one small question from my end. There are a bunch of companies which did very well in terms of numbers for Q3. The predictions for Q4, despite coronavirus fears, were very strong. And we can't quite predict what will happen post Q4 any which ways. And although those stocks have also corrected, would you believe that it might be a prudent idea to try and look at those earnings forecasts and try and buy into some of those if you indeed want to buy something?
Yeah, definitely. So, from our point of view, it's always trying to look at what is doing well and which is, relatively not priced by the market. Typically, when correction like this happen, everything tends to fall, because a lot of people are booking profit on what they've made money on. So quite often some of the stocks which are doing well also tend to fall simply for that reason. From our point of view, times like these are just times to sit back, look at fundamentals and try and think, is this going to get affected by the events around the coronavirus, or is this not getting affected? If this is not getting affected, or relatively it's getting affected less, then we tend to buy those stocks. So it is time, these are always times to buy. If you look at the last, this has been a 10% correction, the S&P, which is the fastest on history. If we look at the correction which was prior to this in 2018, that was at that time the fastest 10% correction. if you had bought that 10% correction, 6 months later you were probably, making decent amount of money. So it is like, you get in at those panic points, you don't know what will happen. 1 week later, you probably are down 1%, 2%, 3% even after that. But maybe 3 months, 6 months later, unless things have really blown up, you probably have made some money. So that's why it's always good at some point to keep nibbling a bit. You'll never catch the real bottom. But, just buy stocks where you think the next 1-2 quarters are going to be decent in terms of earnings growth and the outlook. And, things will revert back to mean once, globally things start to stabilize.
All right. Jyoti, what would your EPS estimates for revised EPS estimates be now? Because this is obviously going to, in a way, affect projections. Do you feel that there could be a meaningful cut in EPS estimates?
Frankly, I would say that at the moment, everything's in the air. Nobody's really sure whether this, maybe we're into April and everybody's hoping once the heat starts, then the impact of the coronavirus dies away. If that is the case, then the impact would be, very small. But if that does not hold out to be true and it continues to last for quite a few months, then I think the impact would be quite severe. So, I think the impact will come from 2-3 issues. One is the fact that the global growth is going to slow down, especially because China is going to slow down. The second worry which I have is the disruption which happens because, the supply chain from China is clogged up. The positive news we are getting there is factories are restarting in China. So there is a move that maybe, 2 months later we'll not be as worried about the supply disruption. And third is a lot of, travel related, leisure related, those sort of companies will start struggling because now nobody wants to travel, nobody wants to hold conferences. So, there'll be an impact of that. Overall, I think, we'll probably be mentally thinking that EPS cuts are going to be 2-3% in terms of the growth rate. And hopefully it won't become larger than that if, things start to normalize by the summer.
Okay. We leave it at that, Jyoti. Thanks very much for joining us and appreciate you taking out the time.
Thanks a lot.
All right, we're down about 2.7% on the Nifty, down 300 points there, and another 743 points down on the Nifty Bank. That's under 30,000, almost under 29,500 also. We're going to take a short break. Coming up is a conversation on markets with Prateek Agarwal of ASK Investment Managers, and talk about the economic impact of the coronavirus outbreak with former RBI Governor Raghuram Rajan.